Is it time to add duration? That's really the question we're going to talk about today. My name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. So for August 2023, our monthly video series, we're going to talk about whether or not it's time to add duration to fixed income portfolios. So fixed income, we're going to spend some time mostly on the bond side of things today, and really whether or not we need to stay short, intermediate, long, or really where in this duration world we need to live. So we'll talk a little bit about what all of that means here momentarily. So why don't we start with what is duration, right? This is a question we get quite a bit. So duration is often measured in years, and it's really how long in years it will take for an investor to be repaid a bond's price, so what they paid for it, via those total cash flows from the bond. So think about it as measured in years, and I think the most important thing to think about is it's a way to think about or way to measure the sensitivity a bond has to movements in interest rates. So oftentimes you see something along the lines of the municipal bond index or the U.S. aggregate bond index. They have a 5 to 6 year duration. The aggregate's closer to call it 6.5 year duration. And if you have a 1 year duration, it means you're going to get paid back very quickly. If you have a 10-year plus duration, it means it's going to take longer to get repaid on that bond. The shorter your duration, the less sensitive you are to interest rate risk. So if you own a bond or a 6-month treasury bond or treasury bill that pays you back in 6 months, your sensitivity to what the Fed does is very, very small. If the Fed raises or cuts rates, the reality is your bond price isn't going to move very much. If you own a 30-year bond, if the Fed raises or cuts rates, it will have a pretty sizable impact, most likely, on the bond you're holding because there's so much longer until you are repaid, and the price of your bond will reflect all of that. So the question we often get asked is, hey, today, interest rates are north of 5% from the Fed funds rate. You're seeing CDs, you're seeing T-bills, even just short-term fixed income in general paying sizable yields. Yields investors haven't seen in over a decade. Is there a reason to go farther out, especially because investors who were farther out on the spectrum in 2022 saw their bonds get hit from a price perspective? The Barclays U.S. Aggregate Bond Index was down over 13% in 2022. That is the impact of rising rates on investors who have more duration than shorter duration. But we're here today to kind of say it's probably time to consider adding duration to portfolios. And let's go through those top reasons. One is going to be the fact that the starting place matters. So today we are at a different place than we were at the end of 2021. At the end of 2021, rates were very low. Today, rates are much higher than they were. Much of that comes from the fact that the Fed raised interest rates 425 basis points, 4.25% in 2022. The good part about that is that if the Fed does raise rates, the impact on your portfolio is much smaller than what it was at the end of 2021 if you projected like movements in interest rates in both scenarios. Second, inflation is coming down. Why does that matter? Is that the likelihood of the Fed raising rates in any meaningful way is much, much lower. It doesn't mean that they're done. It likely means that they're very close to being done. So inflation coming down should give investors confidence that they can go out farther in duration. And the last thing is that because we're close in peak rates, historically, investors who have gone out in duration, or at least moved beyond very, very short-term instruments, money markets or CDs, and added some duration to portfolios, they were benefited on a forward-looking basis. So we'll look at what that has historically shown here momentarily. So let's start about why higher rates from this point forward are less impactful. This is a busy screen that I'm showing here, but it's on the left-hand side, all of the different asset classes of fixed income and what would happen if interest rates rose 1%. Or on the right-hand side, you do see if it fell 1%. But focus on the gray bars and just really focus on the red circles that I highlighted. So that's the U.S. Aggregate Bond Index. And what it would show is at the end of 2021 versus August of 2023, right? Most recently. What happens if interest rates rise 1%? And on our side, we don't expect rates to go up another 1%. Maybe another 25, at most 50. But 25 likely is probably the most we would expect. The Fed, I think, wants to be done. But in either case, we'll talk about that momentarily. But what if the Fed raised rates 1%, which is a pretty extreme scenario from right now? If you rewind to the end of 2021, interest rates were very, very low. Investors weren't getting paid much for owning fixed income. Versus today, fixed income yields are 4, 5, 6% plus, depending on what you own. Back in 2021, if the Fed raised rates 1%, your total return from the U.S. Aggregate Bond Index was down over 5%. In the same scenario today, your return is just over 1% negative. So you can see it's nearly a 4% difference of an impact on your portfolio for the same interest rate increase from the end of 2021 to today. So the impact of higher rates when your starting place is higher yield is much different when you have a much higher yield to start than, for example, the end of 2021 when we started to see rates start to climb from the Fed, especially as we went into 2022 and throughout 2022. Second, inflation is coming down. I think everybody has seen the graphics, the charts. Headline inflation, which does include energy and food, has now hit below 3% at points. We're seeing core inflation, which strips out energy and food prices, drop down into the 4s, hopefully trending down to 3s. We're not at the Fed's target yet, but it is trending in the right direction. And our expectation is the Fed will keep rates elevated, but that we'll continue to see inflation continue to fall over the course of the next 12 to 18 months. It will take time, and you have to be patient, but inflation is coming down. And why is that important? I'll show you a graphic that really displays what the market's pricing in from a likelihood of where rates will end the year. So the graphic shows the different probabilities that the market's pricing in of where the Fed will land at the end of 2023. And you see there's a 60% likelihood priced in as of the middle of August that the Fed will just end where we are today, which is at 525 basis points, 5.25%. They will not raise rates again. There is a small likelihood, or closer to 30%, right, half that likelihood of one more hike of 25 basis points would likely come in November if it were to come. And very, very small chances that the rate environment goes either down or goes beyond the 25 basis points up. So the most highly probable scenario that's priced in the markets is that there are no more movements. The Fed is close to being done. As long as inflation plays by the rules and continues to come down, which has been stubborn, but we do expect it to continue to fall as it has over the last 12 months, the Fed is likely done. So that will help portfolios, that will help bond investors not worry about the rise of interest rates and the impact on portfolios because of it. And the last piece is, historically, investors have been rewarded for adding duration when you hit peak rates. So this graphic shows the last 6 interest rate cycles where interest rates peaked and then the returns from that peak of CDs over 12 months versus treasuries, corporates, and high yield, more traditional fixed income. And you can see in every scenario, once again, past performance doesn't equal future results, but in every scenario, we've seen value added by going out in duration. And why is that? Well, oftentimes after peak rates, the Fed has to go beyond where they want interest rates to land, which is what they'll tell you today as well. They've gone farther than they feel like they need to. But at some point, they will drop it. They will do it because their neutral rate is closer to, call it, 2.5%, 3% in interest rates. We'll see when that happens. They're going to wait for inflation to come down. They're going to wait for potentially unemployment to peak up. But the Fed will likely tell you that they've overshot where they want long-term interest rates to be, right? Their short-term rate to be over a consistent and neutral period of time where they're no longer helping or hurting the economy. So if they've gone too far, the likelihood is that they will cut in 2024 and 2025. How quickly will depend on inflation and unemployment. So not only will investors get their yield, the more you do go out in some duration, you will get capital appreciation. If you think of the opposite of what happened in 2022, when rates rose, bond prices dropped. In the opposite scenario, when rates drop, bond prices rise. So that will happen more for investors who have duration in their portfolio, who own things that are a little bit longer. This doesn't mean you have to go to a 30-year fixed income instrument, but you can go from money market and high yield money market and CDs and extend out to a couple years of duration, right? Adding a little bit incrementally to your portfolio so you can hopefully see some of that benefit. But historically, investors have benefited on a forward-looking basis when rates peak to owning duration, owning treasuries, owning corporates, owning high yield. High yield adds a little bit of credit exposure. We don't necessarily need to jump into that, but even high quality, longer duration treasuries, longer duration corporates can be beneficial, historically speaking. So if we look, in total, we'd say that the Fed is close to being done hiking rates, right? They've said as much. They want to pause. Maybe there's 25 basis points left. A lot will depend on what the data comes out. But the reality is they're close to being done. And our starting place means that any hikes that they do throw in there are just going to have less impact. And historically, adding duration and not just sitting at the short end, we get it. High yield money markets are paying 4.5%. CDs are paying what they haven't in a very long time. But there is benefit to locking in some of these yields on a longer term basis so that when interest rates do drop, you're not having to reinvest out into a falling interest rate environment, because once rates do start getting cut, the first things to start to fall are going to be these high yield money markets and then CD rates, the shorter term instruments. So in total, we do think it's time to add a little bit of duration, not be scared to go beyond the short term. And that's what we're doing in our portfolios. We're not going extremely long. We're not doing anything in any extreme fashion, but it does make sense to go beyond the very short term for the various reasons mentioned before. But as always, if you have any questions, we're always here to answer anything. Reach out to your advisor, my team. We're always here. And as always, thank you for the trust you put in Diversified and Diversified's team. Until next time, take care.